Okay, good evening, everyone. You ready, guys? Yeah. We are Sharmeen, GHAZANFAR, Diego LORETAN, and Andrea PADILLA. And today we are going to present the discussion, or we're going to lead a discussion on the paper that Professor Carolyn Sissoko has just introduced to us, which name is The Collapse of Small Business Lending in the US, Why General Access to Bank Financing Matters. So, how we are going to lead the discussion. First, we are going to present the brief summary. Then we are going to present to you the 3 debatable dimensions that we selected. And we are going to close up with open questions and literal sources. So, briefly, making a recap on what Professor Sissoko has just presented, she documents the problem that happened that started in the late 20th century in the US, which was that US banks shifted from lending to SMEs, and now we're favoring large firms and mortgage lending. This shift at the moment was viewed as a market phenomenon by some, but as Professor Sissoko has just mentioned, this is an expression of wrongly focusing on liquidity risk rather than credit access. What are some of the implications that this problem had, and it's still having, is that only banks have the capacity to expand the money supply. Therefore, the alternatives that small, medium enterprises have nowadays are not enough to satisfy the gap that we have now. The second one is that economic performance is adversely affected. And the third one is that the role of banks is problematic when they lend on long-term assets that are prone to asset price bubbles, as the one that we saw in 2008. And now my classmate will present the second part.
Thank you. My voice is a bit bad, so I hope it will be okay. So yeah, the first part of the paper focused on this theoretical background that you also explained quite thoroughly, so I will not go too much into that. This approach that was called commercial theory of banking, that is related also to some of Schumpeter's ideas, as well as the monetary circuit theories. So in this approach, it's really the banking sector and its short-term loans, mainly for working capital, that is at the heart of a monetary production economy. And there's also this keyword of general accessible finance that was mentioned a few times. So only if the banks loan short-term funds, then these firms can actually join the activity of the economic flow. And the distinction that was also presented, that Sissoko adds the commercial short-term loans to the framework that already exists of productive and speculative finance. So it's also, but there's this additional category of the commercial loans.
Okay, so I will be talking about what Professor Sissoko explains were the main causes of the shift. So first, she mentions in the paper the Volcker shock, which was from 79 to 83. Now, this was a decade of unprecedentedly high interest rates, which crowded out small business lending. However, she doesn't emphasize it as the main reason for why this trend persisted and never shifted back. The main was the Basel Accords of 1988, which stipulated higher capital requirements against commercial and industrial loans compared with like residential mortgage loans. So it became generally more riskier to lend to small businesses. And this basically shifted the traditional role of banks as providers of commercial credit towards mortgage lending and speculative finance. And so the results, as she showed in her presentation as well, that loans to small borrowers, they kind of, from 1994, in 1994, they dropped to only 44% of their 1979 quantity, and to large borrowers, they increased by around 130%. So it was a huge discrepancy there. Now over to Andrea.
Okay, so I will start with the phase development dimension. Professor Sissoko did a very good job in explaining why this is a problem. What we thought that it was really important to try to round up the idea in understanding why SMEs are still important in our digital economy and the digital transformation that we are facing, and also to understand the effects that it has nowadays. So, starting from the importance, even nowadays, SMEs remain the backbone of the both traditional and digital economies. They represent 90% of businesses worldwide and 70% of the jobs that are created. So they play a huge role in our economies. They increase allocative and dynamic efficiency because they constantly improve and adapt the economy, and also they connect the people to the digital transformation. They contribute between 40 and 60% to the GDP of the countries. Of course, this depends in each region, but this is like the average. They also have a huge role in connecting local economies to the global digital markets. They drive the adoption of new technologies because they work as innovation multipliers at a local level, and they are an anchor of regional green and circular supply chains. So, as we can see, they are really important in the digital economy. And what are the effects when the lending of banks to small and medium enterprises happens? So the first one is related to employment and firm survival. It's not only related to the fact that small businesses start to close, but they stop to even open or create new companies. Therefore, and there's like interesting data that the Federal Reserve Bank of Atlanta and the US Small Business Administration present, which says that a 1% tightening in small and in SME credit reduces job creation in about 11%. And also, usually, in the US at least, 1 million loans to SMEs are reflected or create 3.5 jobs in average. So this is important. The second one is that it affects innovation and productivity because firms start to postpone investment in digitalization, and these reduce at the end aggregate productivity. And the third effect is related to inequality and market concentration because small businesses start to turn to costly non-bank lenders or drop into informality, and this at the end makes that the economy is concentrated again in large economies, as we are seeing now with the big tech companies. So at the end, when affordable bank credit declines, it affects directly who participates in the new economy and whose growth is possible and who's not.
Okay, so from the paper, it's clearly obvious that the supply side is heavily focused on, right, on SME lending. And so when we were reading this paper, we thought about kind of delving into what other unique experiences that the economy of US was going through at the time that can impact the demand side, you know. So first of all, I will talk about, I mean, there were a lot of things going on at the time, but the Volcker shock was mentioned by Professor Sissoko, but I think US deindustrialization in that time period should also be focused on. So I will talk about, I mean, there were a lot of reasons, but mainly I will talk about the Rust Belt decline and the China syndrome. The Rust Belt decline is kind of like evidence of deindustrialization, but the China syndrome is more like a reason, but it's a bit later in the 90s. So what was the Rust Belt? I mean, I hope you all know about it, but it was basically the industrial heartland of the US. It was stretching from the Great Lakes region all the way into Pennsylvania and into parts of the Midwest. Now, in the 70s to early 2000s, there were like a huge factory closures and downsizing of manufacturing industries. So that's why it's called Rust Belt, because it was kind of rusting. And, and so what happens that, I mean, there were huge anchor firms like GM, US Steel. So where do SMEs come into play is that when these huge anchor firms kind of contract in size, these SMEs that are, you know, are specialized in the supply chain also lose their permanent customer. So a lot of SMEs at the time made up the backbone of this industrial ecosystem as suppliers, subcontractors. And so when their main customer contracted the demand, they obviously also went out of business. And because they were highly specialized, it made it hard for them to reorient themselves into another industry. So that is a problem for why we can see kind of like the demand side of what was happening to SMEs at the time and how their kind of, you can say SME borrowing was affected as well in this time period. Now the other is the China syndrome, which is when China liberalized its trade and kind of liberalized its economy in the 90s and entered the World Trade Organization. So a lot of Chinese exports in labor-intensive sectors like furniture and apparel, toys, this kind of skyrocketed in the US. And US regions that were specializing in this saw huge manufacturing employment decline. And this wasn't like a short-term temporary thing. It was permanently set up because even after a decade, it never reversed back. So again, SMEs are obviously more prone to these trade shocks, and they never recover from this. So as we see, like Chinese import growth accounts for around 44% of total US manufacturing job losses between 1990 and 2007. So my final question to all of you guys from this point is that as Professor Sissoko presents a very strong theoretical framework and documents a nice strong correlation, but it's not a causation, as she already mentioned. So we can think about what else was happening on the other side, not just the supply side of lending, but on the demand side of borrowing. Over to.
Thank you. So this next critique has already been at least partially and preemptively answered by you, Carolyn Sissoko, because we wanted to zoom in a bit on different SMEs, because the paper focused really on this macroeconomic view. So there's general shift away from SME funds to larger firms, and we wanted to go a bit closer and see how these firms are heterogeneous. So I found a paper by Bates and Robb that looked at SMEs owned by Black and Latino people in the US. And what they find is that actually these SMEs, or the people that own them and run them, are often discouraged borrowers. So these are people that don't even apply for loans. But also if they do get a loan, these are on average smaller than the ones for comparable white-owned firms. And this effect is even persisting after controlling for minority neighborhoods. Very similarly, also there's a lot of literature on women-led firms. The first paper here by Michid and Pernasek is also focusing on the US. And there they also find empirically that women are more likely to be denied credit. And again, there's this side of being discouraged to even apply for it, so to demand it even. And also on a worldwide perspective, female entrepreneurs face specific challenges that lead to the fact that they get on average only 70% of what their male counterparts get. And they also need to pay higher interest rates and put up larger collateral. Then the last point, I think this is a very important one, especially in developing economies. There's also quite some literature on that. Well, in large regions around the world, informal firms are extremely important. They're an extremely important share of the economy. You see here they account for about 1/3 of the GDP and up to even 70% of total employment. So they really play a huge part for many people's lives and for whole economies. But being informal, so not having the legal access or the legal status, can actually then be causally and negatively related to their credit access. So they will not be able to get credit in many cases. So in one study I found where they look at 13 emerging market and developing economies, so in these regions, what they found is that only about 23% of informal firms even have a bank account. So a lot of them are far away from actually even demanding credit, even like let alone getting actually loans. And only 11% have access to loans. And then, of course, if we stay in this framework that is suggested by Carolyn Sissoko, this has huge implications, because then this means that their investment and also the working capital, so the very short-term aspect of their business, would need to be financed through internal funds. So around 80% was the number I find there. So just here. Oh, it's a bit blurry today. I don't know. What's better? Now maybe it's still loading. Yeah. So yeah, this is just a map that shows you a bit the importance of the informal sectors around the world, and it's here in a share of employment. But yeah, and you can see, I mean, many of the regions that are dark blue, so that have high informality, are really regions that where there's growth needed, where the welfare is still quite low, the income is quite low, and it would actually need to increase. So yeah, the takeaway from this point of view, from this more microeconomic view, is that if this SME's access to credit is unequal, this can increase and perpetuate the already existing inequalities. But then more than that, it's not only about these specific firms. Even on a macroeconomic scale, then this translates into foregone mutual beneficial transactions, and also innovation, and finally growth. And yeah, as I mentioned, this is particularly problematic in the regions where this growth, this innovation will be strongly needed. So now we still have some open questions. I think you start.
So our first question is, through what channel can commercial loans foster innovation? Because isn't innovation not rather fueled through more risky productive investment?
The second one is if you have explored or found evidence on how credit shocks affect developed and developing economies differently. The third one is, from your perspective, what concrete measures could help reverse the decline in SMEs lending and rebalance our economies toward greater inclusion, productivity, and equity?
Yeah, I had a bit trouble formulating the fourth one, so I'm going to try to do it a bit more spontaneously. So something that really surprised us in your paper was this part where you mentioned the public funding and the importance of the public funding, because especially coming from a heterodox point of view, this was quite surprising to us. Also, since you emphasized the possibility of banks to expand money supply, so we were kind of surprised that you mentioned this as a limit, that the deposits, if we understood you correctly, are a limit to expanding money supply, whereas I think in the approaches that we've learned more from a heterodox view are more that the credits make deposits. And the last question, yeah, since you mentioned, and I think you make a good case for the importance of these commercial loans for the whole economic functioning, we were asking ourselves, why shouldn't there be the government providing this? And by government, we mean also like central bank, not only in a strict sense, but any government institution. If this is more so, since it's a really technical procedure, as you mentioned, it seems to be very safe. Why couldn't it be the government providing such a basic infrastructure that is strongly needed? And maybe if you want to expand as well, what institutions do you think could best fulfill this task? Maybe other than banks, or if in your ideal world, who would be in charge of that?
Okay, so here are literature sources, and thank you.
She first answer some questions, right?
No, we gave them 5 minutes.
Okay.
Yeah. Yes, yes. And maybe you can even come here and you'll be able to read better the... Yeah,
I think she will mention it, yes.
So first she answers,
and
and
she answers, and then we have the...
Okay, you can do like that. Yeah.
Thank you. Okay. Great, thank you. That was really good. Thank you. So in terms of answering some of these questions, okay. Yeah, so hopefully, I hopefully by kind of explaining the Schumpeter approach to innovation, I'm hoping that one might be a little clear after the presentation. I think the whole idea is that the way that banks can play an important role in funding innovation is essentially by the fact that when an entrepreneur has an idea, they need to, let's see, in order to realize it, they're going to need funding. And I think, so I guess this is the question. Do they need some huge startup funding, or is it frequently possible for them to have, like, starting out small and then growing up? So definitely what I'm proposing is something where you're thinking a little bit more about them being able to start up small, and build up from, an initial factory and then kind of grow into something bigger over time. That's how kind of commercial financing works. And so I think it's completely fair to say that there's a role for productive investment as well. But I think the thing is, you kind of need both, right? And what I guess I'm worried about here is that, yeah, it's fine for, say, a small to medium-sized producer to get a little bit of risky startup capital. They're still going to need the working capital as they go along. Like, you get something started, it's going to be really helpful if working capital that allows you to do transactions that will slowly increase your supply, and so that you are not, slowly increase your production, and mean that you're not constrained by the fact that, I need to make the money first before I can buy inputs to expand. Right? And I think it's kind of at that level that this commercial lending it just adds a whole level of making innovation so much more smooth. That's really the argument that's going on there. And I think, yeah, I think there's a tension there because there is also a need for productive finance. Like, I'm not saying it's not necessary. I'm just saying that in order to make innovation work well, you have to have the commercial sector as well. You have to have the commercial financing sector as well. So then question number 2, how about credit shocks in developed and developing economies and how those work differently? I have not really explored credit and banking properly in like any developing country, so I can't speak to that really well. I mean, in the sense that, like, I kind of have a good sense of how the banks work, like in the US or in the UK. And I do think that I guess when I talked about the fact that if you think about how when certain people are excluded, it's going to completely change. So if I gave the example of black Americans in the US. When they're excluded, that actually changes completely their ability to build wealth. I think that you can take this as well, kind of on your whole global dimension. Like I said, I spent a lot of time studying 19th century British banking. So what's one of the big characters? There are eras in British banking where you have this incredible, generally accessible working capital finance, and you have this like really amazing small-scale growth. In Jamaica, which was at that time owned by Britain, completely controlled by Britain, there's just no question that it was a very limited class of people who had access to that kind of funding, right? And that's a whole, I mean, so I think if you want to look at colonialization, you can study it from the point of view of money. Like, you know, if you want to look at why do we have some of these differences, there's going to be a whole aspect of, are you well tied into this monetary system that works well to grow, you know, Western European and, you know, the U.S., Canada, Australia. Like, are you part of that system, or are you someone who doesn't have access to that monetary system? And I think there's an element there to look at. But in terms of look at the micro level of how does banking work in a developing economy, I don't have that information. But I think there are aspects of this that can address those kinds of questions that are interesting. Okay. So what concrete measures could help reverse the decline in SME lending and rebalance our economies towards greater inclusion, productivity, and equity? So the key thing I look at here is bank regulation. I spend a fair amount of time studying bank regulation. And so one of the reasons I'm coming at this from a theoretic perspective is I think you need regulators who reconceive what the role of banking is. The problem is what's inside their heads. You know, they're all about, how do I keep my banks from failing? How do I make sure they have enough capital and enough liquidity? And you kind of want to say, okay, those are important, but a question that is equally important is, how do I make sure that the firms in my economy have good access to finance? That question should be at least on an equal rank with capital and liquidity, right? What is the accessibility of those? So I would actually say the way to change it is actually to completely rejigger regulation, so that you actually say, it's almost like you want the regulators to kind of be looking at making sure that banks are they even don't have discriminatory interest rates. I mean, so basically the whole lending process right now is like, okay, big borrowers are less risky, and this is literally in your regulatory reports, they're therefore going to have lower interest rates. I mean, the whole system is biased against the smaller borrowers, and I would actually say you should be putting a finger on, like, actually, no, we want to make sure you give small borrowers access. And I think the real tricky thing here is, at the same time, there are bad borrowers out there, and there are plenty of bad small borrowers. So you want to kind of encourage this to happen, while at the same time you have to leave in the fact that a bank has to be able to say that borrower is not the right person to lend to. And so it is, I think, I would say the first thing you want to do is take away all of the regulatory fingers that push towards large lenders, and see whether that's enough to encourage lending to smaller size businesses, but also maybe encourage not charging discriminatory interest rates. There used to be something that mattered in the US called the prime rate, like they still have a prime rate, but it used to be that as long as you were a solid customer of a bank, the prime rate was the amount you'd get. That should not change that much because of the size, right? If you're a good borrower with a good history and there's nothing that makes us worry about your business collapsing in the near future, maybe that you should be able to get that same interest rate. There should be kind of like a prime rate across the board for everybody who's in good standing and we're not worried about. So maybe that would be, that kind of thing is the thing I'd be thinking about. Regarding the idea that, I definitely did not mean to say that banks as financial intermediaries rely on public funding. I guess I think in that section of the paper, all right. So as a matter of accounting, when a bank makes a loan, it is funded by deposits, right? And that's just, so when you look at it from the accounting perspective, it's true, the loan comes first, and then the deposit comes. But as an accounting perspective, the loan is also considered as funded by the deposits, right? So I don't see anything, I don't actually see a contradiction there, basically. I would basically say that even when deposits fund loans, it doesn't mean the depositor is knocking on the door to put the deposits in the bank. Part of it is that, you know, the depositor does can get the funds by getting a loan out, and I would still use the words that depositor, those deposits are from an accounting perspective funding the loan. So part of it, I'm kind of, I think I've done enough accounting that for me I don't see the contradiction with it, but I definitely, yeah, I'm not thinking of banks as financial intermediaries who rely on that funding in the sense that the funding comes first, right? It's just as an accounting perspective, when you look at the accounts, if they have a loan, it has to be funded by something on the liability side of the balance sheet. That was all I was trying to get at there. But I think also, at the same time, that section of the paper, what I'm looking at is we all, every single person who has our deposits in the banking system, right? We kind of, we are part of this system that provides financing for the economy, and that's the sense in which it's a public entity. Like, I cannot walk away from the banking system and say I'm not going to have anything to do with it, right? We're all tied into it, and in that sense we should think of it as a public entity. So I guess, does that answer it reasonably well, or?
What we were surprised was also the limiting aspect. So for us it was just not clear because then it limits somehow the loans, I think, or it limits the money supply. This was.
Did I say? So I say at some point that it's a constraint on the money. So maybe I do. I mean, it's
a limit of principle, something like that. You mentioned in the part where you said that these are very safe and they don't need to, like, use bubbles and.
Oh, okay.
Somehow limiting it, and this was the most confusing.
Okay, so all right, so yeah, okay, all right, so yeah, I mean, all right, when I talk, yeah, so now I think, so this is the thing, it's basically, the idea I'm trying to say there is when you have loans that are very closely created to commercial transactions and essentially like completed commercial transactions, that is the limiting principle, basically. It's the reason you're shaping the loans, right? which is very different from something like when you have, like what's going on now, like the bank loans that funded Elon Musk's purchase of Twitter, right? Like, why would the banks have done that, right? You know, and that's the sense in which I'm like, there's no limiting principle. If that's the kind of lending you're doing, I mean, I'm sorry, the value of Twitter is just some made-up thing. Like, it's not, there's no reason to believe it had the value that justified that debt. But then, as long as you can keep getting banks to fund what you're doing, it becomes irrelevant. But at the same time, I kind of sit here, I'm like, sometimes this is all going to come down and it's going to be ugly. But at the same, like, I mean, that's the sense in which I'm like, there's no limiting principle for that kind of lending. Whereas if you focus only on completed commercial transactions and you actually transfer those iPhones over to somebody and it's about how do you pay that iPhone bill, that has its own sense of limiting things. Okay, I probably should keep going. So, if commercial loans are part of the fundamental infrastructure of a monetary production economy, shouldn't the government provide it? And yeah, okay, so I think this is a good question. Like, should the government provide this kind of lending? And I actually kind of, given the system we have now, I would actually be all for public banking, or even sometimes it's called post office banking or something like that. Like, I think that's that's probably the best way to get rid of our bad banks, is to actually get another competitor going that would do really plain vanilla kind of banking, and essentially offer a lot of those services. So I don't think there's a problem with that. I do think the one good thing about bank lending that you might run into if you have public lending without really strong controls is, technically, if we didn't have these banks that get bailed out all this time, so if you think back to another era when if a bank failed, it was its owners who lost the money, that should be a mechanism that encourages them to do lending well. Right, and to originate their loans carefully. So if we could get back to a world where we aren't bailing out our banks all the time, there are things that like private sector banking could bring, which is in particular, people might be really cautious about their lending if they're at risk of losing money. But it's kind of far away from the banking we have. So I'm kind of like, public banking might be a much better move given where we are today. All right, so thanks.
Once everyone has found their place again? No? Laura, parlo di te. Laura di Benedetto, esatto. Okay, so we thought the first 20 minutes, more or less, yeah, would be questions, direct questions to Carolyn Sissoko. So, does anyone have any question? I see 1, 2, 3, 4. Okay.
I can go.
Okay. Well,
You?
yeah. Start with. Sorry. Can I? Yeah, we'll take about 4 questions if that's okay for you.
Okay. Do I introduce myself? Okay. I'm Daniela Morales, and I have a question. And country, Colombia. My question is about the potential for a shift or a change. How do you analyze that? And if, for example, fintechs or any crowdfundings of any sort, the more plurality in actors could change that, this collapse in lending for small businesses, and if such, if it could support the productive financing.
Hello? Oh, I was also going to do a question.
Okay. Okay.
Mine is also a little bit related to that, like, what role do alternative finance instruments do they have? For example, in my region in Mexico, we have many communal banks, and those are the main source of banking in the small and medium enterprises. So I don't know if you think that this could be like a role in to like give finance to these kind of enterprises?
Hi, I'm Thuy from Vietnam. First of all, I want to give thank you for the presentation and also a compliment to our mates because you take a very comprehensive approach about the role SME because you cover labor, digital, international penetration, blah, 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 which is very good. So I'm trying to formulate my question a little bit. So we talk a lot about regulations. So we know that it makes sense for banks not to lend money for small SMEs because it's kind of risky. So if you look at regulation in which they motivate or like to give incentives to banks to be more innovative in terms of providing more product and services for SMEs to get approach or to get a loan from the bank. Are there any policies like that? Because probably we see that the problem here is that not only about SME, they don't know that they have, like they cannot find the product that they want from the banks. And also we talk about like risk validation, in which now digital transformation can help a lot in risk validation based on data. So I wonder from regulation side, do you know any case study about that and how it is going on in the US? And also I'm a little bit curious because I don't see the role of central bank in the whole presentation. So I'm not sure, but I just want to raise the question. Thank you.
Hello, I'm Ben from India. Thank you for your presentation. It was quite informative. So I have this one. You mentioned that banks have reduced the level of spending towards SMEs, but this gap is replaced by sort of non-banking financial corporations or commercial papers. And you mentioned that banks aren't the same as NBFCs because they create money supply, which is true. That makes sense to me in an aggregate level, but how does this specifically affect the SMEs that a non-money supply creating institution is funding the SMEs? Although it affects in the macro level, how does it specifically affect the SMEs? Thank you.
All right, yeah, thank you very much. Those are good questions. All right, so I think kind of actually, you know, the three of them at least started to get into like other actors, fintech, crowdfunding. And I guess I think those are good and it's absolutely valuable to have them. But one of the things I think, this whole idea that the banks can create money actually does mean that those funders are at a disadvantage, right, in terms of doing this kind of financing. And so I would say that I'm just skeptical that you can replace the kind of quantities that were lost. And so I guess I think maybe what I want to say is if you look historically, huge portions of the largest bank's balance sheet, say, for example, at least 25% of their commercial lending used to go to small businesses. And there's something valuable in having that kind of activity. And I'm just, I mean, so there just seems to be an assumption, and I think this comes from how we're trained to think about markets, that, oh, well, maybe somebody else can just step in and do this. And that's where, like, the fintech or the crowdfunding, that's where that's coming from. But at the same time, the crowdfunding, basically somebody needs to step up and say, I'm going to put my money in this platform to do this. You can't just have the bank saying, you've proposed a good plan, right? And I don't need to get funding. I'm going to choose to give you deposits to do your activity, right? That's a very different thing from a crowdfunding platform where you have a good idea, but now we somehow need to get enough people to decide to put money into the crowdfunding platform to invest in it. And my sense is that those don't tend to scale up the way banking does, right? So that the scale is not likely to be similar. And so I'm kind of, or so did I address kind of your fintech crowdfunding question? Is that okay? Okay, and I think I just want to say, so I'm going to go over to the last question quickly because I think it's related, and this idea that like non-bank or commercial paper was, stepping in to replace what that lending. I don't think there's any evidence that it was replaced by other things. I think the thing is a lot of businesses closed, right? The lending didn't take place, or to the degree that it happens, I think another strain that might be interesting, look at credit card lending. But the thing about credit card lending, so the story is a lot of small businesses now fund themselves on credit cards in the United States. You're paying 20% interest rates on those loans, right? That's not at all the same kind of thing as the commercial lending the banks used to do, where you could get a loan at something close to prime rate, right? So you're talking about at least double the interest rate of what you used to pay, right? And in that sense, I think the substitutes are very poor, right? They're not comparable to what is lost when banks do this. So I'll come back to that. I just wanted to throw that in. And then things like communal banks in Mexico. So I think this is one of the interesting things that, like the book on African American banking in the UK that Mirza Badasaran wrote, is that it's important for the banking sector that's making the loans to actually kind of be fully integrated into the rest of the banking system. Like when you have these little sub-segments of the banking system that actually isn't fully integrated, it doesn't work so well. And so one of the things, and I obviously don't know the details of how communal banks in Mexico work, but if you want to look at like what happened when they tried to have like, African American banks that are going to fund the African American community, frequently, like, if you actually trace what happens is they're good at collecting deposits. They're not good at lending within the community. The money tends to escape out into other areas and this kind of thing. And so I think that's my question. Like, it would be really good to have community banks that are really good at financing the local community, but at the same time, they need to be well integrated into the rest of the banking system where, basically the purchases people are making with those funds and with those loans give them access to the whole broader economy. And I think sometimes you end up with enclaves as opposed to an integrated system. So, I think that would be my concern. It's important that, like, the whole banking system be willing to participate in this. And it's possible maybe you have your big banks give some funding to the community banks. There may be ways to structure this as something like that, where that's how to structure it that way. But I do think you need to be careful about some of those issues. So regulation. So SME, innovative product services. So how do you, what are regulations that can make it so that SMEs can access the loans or know about the loans, can find the product? And so at least, kind of in the old vision that I'm thinking about, the bank where you have your accounts is actually frequently, like, so if you're a business, you have a business account, that bank is frequently very well placed to figure out how to lend to you well. In part because they're watching your revenues and this kind of thing. So they can they're watching how your revenues come in and how much you're sending out, and they just have a very good sense of how your business is working, right? And so ideally, it's the bank with which you bank is like okay, this kind of loan is available to you, and you can just, it's just part of the banking system that as well as holding your deposits, they're also going to have loans available at reasonable rates. So that would be ideal in the sense that that's kind of what makes most sense. That's how it's traditionally worked. In part also because that bank that is watching the flows of income go in and out can be pretty confident about what kind of lending you can handle and what would be appropriate, right? And then also kind of, there's a classic thing, like they send you a letter, like things are looking a little shaky. What's going on? Can you, it's like we're going to have to cut back lending if you don't start, like they have those kind of ongoing conversations basically where the bank is actually working with the borrower to try and manage the loan well. So that would be the traditional way to do it. I think. You folks come from so many different countries. I think one of the problems is every country is going to have different local situations, and so it's, I can easily imagine that you might need outreach in some countries or in some areas of some countries in order to build up an effective lending system to target SMEs. But I have to admit, I kind of feel like I need to know the specific circumstances of the specific area. It ends up being very location specific and, and that kind of thing where I kind of need more information to recommend that. I think the risk validation based on data, I think, so one of the things that's happened as we moved away from the traditional banking system where it's like, okay, literally the bankers, you should just watch the income and outflows for business bank accounts, and that was kind of how they did risk validation. They knew what was going on in terms of people's bank accounts. And it's interesting because we have very much moved to a world where it's more like, I'm thinking more of the US situation because that's what I'm more familiar with, but it's almost like there are automated lending criteria. Right? So you put all your information into the database or whatever, and that's what's going to determine whether or not you can get the loan. And oh, that's okay. All right, sorry. Yeah, and yeah. So yeah. I'm skeptical that algorithmic lending works as well as old-fashioned lending practices. So I think part of it is also building up some of the skills that maybe have been lost as we've moved away from doing that. In terms of the central bank role, the central bank, I tend to think of the central bank as typically your backstop, your lender of last resort, that kind of thing. And also, of course, they play a role in making the payment system function. But I guess I think the key thing maybe is to work on how the pieces at the local level are actually working is more important in what I'm looking at here. And then just the final question. Non-banks are funny. So I have non-banks were funded by non-money. Sorry, can you give me what was?
I was just asking. Basically, banks increases money supply, which makes them special than the non-banking firms. And now this gap created by banks not funding their SMEs is being taken over by the non-banks. And I was just wondering. This affects the whole in an aggregate level because they are not increasing the money supply at the economy level. But in a micro level, how does a non-bank funding SME is different from a bank funding SME other than the interest rate?
Yeah, I have to. I think if you can get the loan, it's fine. I think there is just less availability than there would be. If you actually had a banking sector that was focused on making sure that the SMEs had, this transaction-based finance. So I guess I'm not convinced that you actually do have this step in, at least at anywhere near the scale that's needed in terms of the financing. Sorry.
We are running out of time very quickly, so maybe try to keep the questions as brief as possible, if there's more. Okay, I think 1, 2, 3, okay, 4. Okay, let's start.
Well, my name is Luca. I'm Brazilian German, and well, my question is the following. I wrote my bachelor thesis about the Brazilian Development Bank, and what we observed in the 2010s is that there was, during some years, an expansion of credit to small and medium enterprises. And my thesis was about the credit lines for bigger enterprises, for big Brazilian construction companies going abroad to Peru, going to African countries, mainly Angola. And what I found out in the end of my thesis, after a long, I think mistake I was doing, was that actually the credit lines were reacting to other phenomena in the economy, and they were reacting to more complex structures that expand a little bit the monetary and banking side of the system as a whole. So my question would be a bit on the causality of this, what you observed in the US. Maybe if you could say a little bit more about maybe other factors, other than the banking part that could have influenced the reduction of demand for credits in this section of companies.
Hello, my name is Theo. I'm from Germany, and I would say I have a little bit more of a general critique, so to speak. So maybe you could explain a little more about the relevance of this topic for today's socio-ecological and economic challenges. Because let's say we manage to increase this lending of small, medium enterprises, which problem does it actually solve? Because I still don't really get it. Because precisely we don't live in the world of the 70s, 80s or 90s anymore, where the only problem we had was to increase economic growth and maybe a little bit of social equity. And talking about small, medium enterprise lendings remains within the capitalist logic of competition and accumulation, where economic upgrading is always achieved through individual entrepreneurial success, and instead of pointing towards the need for redistribution of wealth in our society. And it doesn't question the market logic that inherently always produces losers as well, and it doesn't question the growth imperative in our economy that brought us the ecological challenge that we see today. So what's the point of having a lot of small, medium enterprises that all produce more or less necessary goods for our society, and maybe the most efficient, resource-efficient way to satisfy the needs in our society is not through small, medium enterprises, but actually by taking advantage of economies of scale, of big corporations, but instead sharing the output of them more equally from the members of our society.
Hello, my name is Eugenia. I'm from El Salvador. Thank you for your presentation. My question is related to the financial inclusion policies. I wonder whether the United States have a financial inclusion strategy, and if it does, if there are actions that are focalized on the SMEs, or if this is even a way in the United States, because I know in other countries where they have a plan. So there are some financial institutions, private and public banks, also bilateral banks, so they are committed to a plan, and they have to implement actions that are focalized to certain vulnerable groups, including the SMEs. So this is, of course, for developing countries, so I don't know if it works the same in the States, or if this is even a possibility.
I'm Luis from Germany. As you explained, that companies nowadays rely mostly on credit supply instead of big amounts of collateral for leverage buyouts. My question would be about Alphabet, the company behind Google, which holds vast amounts of cash for some reason. Do you think this has to do something with their access to credit supply for such killer acquisitions they need to do to acquire innovative firms and integrate them into their ecosystem or stop their innovation?
Maybe a last one, I'm afraid, if there's one. There was here, right? I don't know. If you can
Maybe connecting a bit to Theo's question about the social implications of your research. My name is Marlene, I'm from Austria. I wanted to ask, because you mentioned very briefly in one sentence in the conclusion that this dissatisfaction with the economy that doesn't meet the needs of the average person has a big implication that people vote more for right-wing parties. So like as a political, like maybe from a political point of view, maybe you could expand a little bit on that. Thank you.
Great, thank you. Yeah, okay, so the first question was, with reference to things like the Brazilian Development Bank, and the fact was that when you looked at the research, the causality was that, other factors maybe are what's driving this, and, maybe it's not a bank-driven phenomenon. And I think, all right, so obviously proving causality, I do not have a way to prove the causality, but I think the story I would tell for why my causality story maybe should be convincing is that if you look at the Volcker shock data, right? You had a huge drop in credit to SMEs. We know there was a vast amount of failure of SMEs. We know, in other words, that you can actually look at the data and see that it wasn't that they actually had a lower demand for credit. And then I think the evidence for it is, look at what happened to the large companies, right? The large companies were in the same crunch. And what happened to their credit lines is that they took out double the credit, right? The way they survived the Volcker shock was by borrowing more, right? And that's what got them through. And so I think when you look at what was happening with the large companies and the fact that it was a situation where what they needed was to borrow more, I just think it's really hard for me to be convinced that what was going on from 1979 to 1982 in particular is going to be explained by the demand for credit, right? And, all right, so I think when you look at particular episodes, you can, I think you can probably talk about what makes sense in causality better. I haven't actually looked up the data, but it's like you can look up, the degree of failures at that time. And so, yeah, I think it is something to be sensitive to, basically. And so I'm trying to spin a certain story that tells a certain causality. And I think there's no question that I do need to be sensitive to the fact that there can be other factors that are going on. But I do think that ends up being something where you have to look very narrowly at specific years and specific things and what's going on, right? So I think it's really easy for me offhand to talk about like the Volcker shock. But also, it's just interesting, even if you're going to look at the credit crunch that takes place from 1989 to like 1992, why would it be that the small businesses have so much less demand for credit suddenly in this period? Like I do think there need to be support for this kind of targeted decline in small businesses if that's the story you're going to tell. But yeah, causality, like yeah, I cannot prove the causality of my story. It's like this. So I'll be right up there that I think it really is a matter of trying to work through a lot of factors. So the criticism is well taken. In terms of, let me just make sure okay. So this is, yes, okay. So the relevant of the topic for today's challenge is that I basically am using very much a capitalist logic, and that maybe what we really need to do is take advantage of big corporations and then share their product more equally. And so I think the first thing I would say, and again, this would require a lot more research and also be very difficult to demonstrate in terms of causality. But one of the characteristics of this whole period of financialization is that we went from, you know, your Trente Glorieuses and the wonderful growth of a certain period, right, to much flatter growth and kind of like, why aren't things working so well? So I'm not actually convinced that the best thing to do is to put all the production in the big companies and then share it. I actually think that even if you're talking about, all right, I mean, so I think from the perspective of the conjuncture where we are right now, you need to worry perhaps about very different kinds of production. Absolutely, we need to make sure our production is shifting towards things that are much more climate sensitive. We're producing things in different ways. I suspect that actually small businesses have a big role to play in transitions like that, and that actually we'll be able to do much better if we can get financing for a lot of these little ideas to build that up. So I mean, in other words, even for the things that we're very clear that we need to do to move away from some of the disasters capitalism is creating, and I will admit, I mean, part of this is I do come from a respect for certain kinds of markets. I want well-regulated markets that allow people to achieve their ideas and that kind of thing. Like, I think there is a place for what is probably a capitalist logic, but also not like what we have now, like a completely different capitalist market that's well-regulated and constrained and fits in a different kind of box. So, but I mean, yeah, when I talk about funding SMEs, there's no question I am taking a market perspective, right?
But what is the role of small enterprises? What is the issue?
Well, so I think the thing is, the idea is that they do have a lot of innovative ideas. Like, if you look at where innovation comes from, usually it comes from somebody who maybe was an employee for a big company and saw how making these solar panels worked, and they're like, you know what, I can improve this by doing this. They have this idea, and the question is, can they realize it? Right? And I think that, you know, you shouldn't underestimate the fact that when you actually study where successful innovation and transformation comes from, there's a fair amount of research out there that says fairly clearly that actually the ideas tend to come from small businesses, not big businesses, and focusing on big businesses isn't the best way to get from one point to another, even if it's like climate change, whatever those points are. There's a fair big corporate structures, and I speak as someone who works in a university, have management and lots of issues, and all you need to do is to talk to people who work in them, and it's like, the nice thing about a small business is it can be dynamic, it can be new, you can move into a new business, and if you can expect to get financing for that you can have, there's a real dynamism that I think comes from that kind of thing that is actually a positive thing. And that is a capitalist logic. I will admit that I have that element of capitalist in the way I think about things. But I think it is because I suspect that it does bring some value. I think I'm going to go ahead and skip to the last question, which was about, like, wait, what about, how does this fit in with right-wing politics? And I think, so one of the things about this vision of the ideal banking system that makes sure that everybody with a good idea can get a fair chance at access to credit. It does, you know, it ends up being a more inclusive economy from the bottom, right? And I mean, and in that sense, I do think that one of the things that's going on in a place like the United States is that all the money has been flowing to the top for like 3 or 4 decades, and just the whole degree to which the business community has turned away as someone who's a consumer of products from giving you good service and a product that you want and can rely on to figuring out how to get you to pay extra money for stupid reasons, right? That actually kind of, the advantage of having everybody have access to funding and this kind of thing, you might have more competition. Maybe we can get rid of some of that. We can have some competition to get rid of some of this kind of structure that makes all of us feel like we don't have control of our lives, basically, in the way that we need to. And I think that's part of what's going on, is that people basically, too many of the jobs that are available are ones where they're asking you to abuse somebody else, or else, it's like, and it's really hard to get ahead, and this kind of thing. And I do think that's part of an economy that has been sending money upwards for 4 or 5 decades. So I think that is part of the story I'm talking about. The question on financial inclusion. Does the US have a strategy? Does it focus on SMEs? So what the US has is a small business administration that it basically encourages banks to make small business loans. I think what it comes down to is it's probably much less structured and targeted, especially well-targeted to SMEs, than a well-run development bank in many developing countries. And part of it is that the US kind of has had a big business focus for a long time. So even when you look at the SBA loans, like, they tend to go to the bigger small businesses. Like, they're not at all good at getting to like the small scale small businesses, and there's not that much effort to do it. So we do not have in the US a really effective structure for focusing on SMEs, although, yeah, we have official things in place that are supposed to do that. But I actually think you would find that the US could probably improve by taking a model of some of the development banks that are out there. Like, so that's part of it. On the other hand, my theory also is kind of, we need the whole banking system doing this. We need the whole resources of the banking system also playing a part in this. So one thing is, I'd be worried that, a development bank tends to have less resources than if you have the whole banking system focusing on it. Okay, and then in terms of Alphabet and cash, all right, the specific cases, I'm not. So does Alphabet's cash supply have to do with their access to credit? And yeah, I mean, to give a good answer to that question, I would actually have to sit down and look at like Alphabet and the purchases it did and this kind of thing. But I do think one of the things you'll find is that at least, so one of Google's strategies is there are a whole bunch of startup companies that have good ideas. And Google will basically purchase them before they become competition. Sometimes, in some cases, it's to advance the project, but I mean, there are so many complaints of so many different aspects of Google where they actually buy the project and then just stop it. Right, so it was a really valuable thing that they offered, like something about RSS feeds that I've never really understood, but Google ended blogs at some point in a way that was really disturbing to people who relied on those tools, this kind of thing. And I think what I would expect to find without actually having done the search is that when they do some of these transactions, they're going to be getting some funding to support them. So they're providing part of the money, but there probably is also some other funding coming in on the basis of like stock shares or something like that as collateral and this kind of thing. So I'm not sure, but it wouldn't surprise me if in a bunch of these transactions, they actually are relying on bank funding. In a bunch of the transactions they're doing where they're doing a bunch of these deals, mainly because it's just the norm. That's how people do deals in the US. On the other hand, I'm speaking without actually having done the research, so I could be mistaken. Yeah.